You just bought or are thinking of buying a short-term rental. Maybe it's an Airbnb, maybe it's VRBO, and now you're asking yourself, how does this actually work come tax time? How should the property be reported? Do I report it like a normal rental property or like a business? Let me break it down for you. My name's Matt, and I'm the CPA and founder of TrueBooks. We specialize in tax and accounting for real estate investors and small business owners. And today we're diving into 2 ways to report a short-term rental. When it comes to STRs or short-term rentals, you've got 2 main options when it comes time to report your income, Schedule E and Schedule C. Schedule E is what you'd use for traditional rental properties like long-term rentals, my kind of investment. Schedule C is what businesses use, like someone running a cleaning company or a boutique hotel, like a bed and breakfast. Now, here's where people get tripped up. Just because your STR is in real estate doesn't mean it goes on Schedule E. The IRS actually has very specific rules depending on one thing: what services you offer during the stay. Let me break that down. You'll report your STR on Schedule E if you don't provide substantial services. What exactly are substantial services? We're talking about hotel-like amenities, daily cleaning, meal service or breakfast, concierge or transportation, changing out linens every day, anything that goes beyond basic lodging. So if all you're doing is handing over the keys and providing a place to sleep, you're probably in that Schedule E territory. And that matters because Schedule E income is not subject to self-employment tax. So yes, you'll still pay income tax on your profits, but you avoid paying that additional 15.3% like a business would for Social Security and Medicare. And that's a big deal. Now, if you're providing substantial services, you're now looking at Schedule C. This means the IRS sees your rental as more of an active business and not passive like other rental properties, like a long-term rental. And here's what that means. Any income you earn is now subject to that self-employment tax. That's in addition to your regular income tax as well. So let's say you earn $50,000 in net income from your STR. You're not just paying income tax on that, you're also paying that 15.3% self-employment tax, and that'd be over $7,600 in extra tax just for putting that same rental on Schedule C. Now, Schedule C can come with benefits like retirement planning, losses that can offset W-2 income, and broader deductions. For example, you can't set up a solo 401k under a rental property. You'd need a business. Offsetting your W-2 income, for example, if you make $100,000 being a department store manager and lose $40,000 on your rental, keep in mind you really didn't lose $40,000. This is just a paper loss. You can only pay tax on $60,000, that 100 less the 40. Then broader deductions. It makes it easier once you're offering substantial services, opens up opportunities for travel, retirement deductions, and as we mentioned, a ton more. So running it more of a business gives you more deductions. Now keep in mind when you offer substantial services, you naturally will have more expenses because it's going to cost for those services. And remember, you'll want to know which route you're going down before you start hosting guests so that you understand what your tax situation is going to be. And now you're probably asking, which one is better? And the answer is, it depends. It depends on your strategy. If you want to maximize cash flow and minimize taxes and have less headache, you'll probably want to avoid substantial services and stick with Schedule E. That's my kind of investment. But if you're going for a more hands-on approach, hospitality style, business with more tax planning, with premium pricing, hotel-like services, bed and breakfast, Schedule C would be the better play, especially if you're aiming to do retirement planning. And again, use those losses to offset other income like your W-2 or other businesses that maybe you or your spouse have. So again, it's not about which one is better. It's about what fits your strategy. It's about what you're trying to accomplish. And now to recap. Schedule E is for properties with no substantial service. You're avoiding self-employment tax, keeping things simple. Schedule C is for rentals with shorter stays and more service. You'll pay more tax, but open the door for more deductions and more tax strategy. So figure out which one fits your setup and track it from day one. And what I mean by tracking is do your accounting and your bookkeeping. Keep good documentation for everything you're doing. You know I'm a stickler with bookkeeping. It will screw you in the end if you don't do your bookkeeping up front. And if you want help structuring or how to structure your STR business or want a free cheat sheet that shows you how the IRS defines substantial services, check the link in the description and we got one ready for you. And as always, if this helped, make sure to subscribe and leave a comment below. And let me know any other STR tax questions that you want me to cover, and I'll be sure to cover them in a future video. See you in the next one.